Hey, good morning, everyone. Marty Missouri here. It's Wednesday, the 19th of July, 2023. This will likely be my last post actually through this coming weekend. Of course, I'll still score our PWA index and record it, but won't be doing a video on it. And this will be the only stock market snapshot we do this week. Tomorrow's schedule and then an end of week backpacking trip. We're going to preclude anything else, probably on the blog. I mean, I could pop in early tomorrow morning, but right now let's just assume that this is the last you'll hear from me until early next week. So just a few points I want to make, and then just a super quick look at the chart. First point in front of you is the graph or the chart that I presented on this morning's written note that I titled Maybe Breadth Matters. And first of all, let me tell you that breadth has improved markedly. It's not perfect. I still have bearish divergences on most of our breadth indicators, not on the S&P advanced decline line, but hugely on the one, and again, this is the screen in front of you, the NASDAQ composite advanced decline line. The percent of S&P members that are trading above their 50-day moving average is pushing like 80 or so, and it's a good number on the 200-day moving average as well in terms of percent of members beating them. Still bearish divergences, however, from the last peak relative to price, and a bearish divergence is where you have a lower high versus the price chart, which gives you a higher high. Now, again, that's quite pronounced. Here on the NASDAQ composite, as you can see, we've had this big rally off the bottom, right? And just a massive bearish divergence on the advanced decline line for the NASDAQ. And that speaks to the fact that you have now this magnificent seven. They've been calling that more so than the fangs lately. And looked at a statistic or a chart yesterday that showed that if you took out those seven stocks, the S&P would be up 4% year to date, not in the high teens. And this, of course, confirms that. It's just still, even though it's improved, a very narrow range of stocks that are actually doing anything of note this year. And then, of course, what we need to do is go back historically and say, what might that mean? Well, this to me is a very similar looking setup right at the all-time high for the NASDAQ back in November, December of 2021. And again, while you can get false signals all day long, I don't know. This one's pretty striking. So we'll see. Ultimately, I think this market is exceedingly heavy, and I think these magnificent sevens are out over their skis. There's a lot of macro factors that could really bring that tumbling down, particularly since a lot of the people have moved over to the bull side of the boat right here. Again, not making a prediction, just saying that things now, ironically, as people are getting more bullish, things begin to get a little thinner in terms of the support for the market. These things work in both directions, though. You see how we had a lower low, and then we start at the bottom on the breadth. And we had a nice pop. Now, long-time clients, if you think hard, you may remember back, although I think I've gone back and reminded you on this one on the videos, that real nauseating stretch from 2014 to 2016, where point to point, the market didn't do anything, the stock market, except for a 16% decline in the middle. And about 6 months before the market broke out, the advanced decline line on the S&P broke out solidly. So you had a market that was basically flat, but you had this advanced decline line that essentially was flat until, again, about 6 months before. And we were calling that as a very strong sign that the market was finally going to break that consolidation of 2 years, but we thought it would break to the upside. And it turned out to be the case. And this has been a good tool for us for measuring potential downside risks. So anyway, you get the point. Right now, that's a concerning look to us. And then just the daily chart, we'll just keep it short this morning. On the S&P, Here was that all-time high. This was January 2022. You see how we went out, new all-time high, broke down, new marginal all-time high, and then finally rolled over. And underneath the surface, as we were rising into a rising wedge pattern, we had very notable bearish divergences. And we had rallies along the way that were somewhat foretold by these technicals. Well, you just don't have that right now. You have a very similar look. You have a high, a bear market high, not an all-time high yet. Then, came down, bounced, and here we have a new marginal bear market high against bearish divergences, and frankly, more overbought here on the RSI than we were here when we ultimately rolled over. So again, a pretty heavy look is the term I want to use. This doesn't look like a market that's bottoming, so to speak, or a market that's ready to thrust higher. It looks like a market where there's some not small risks that it ultimately could roll over before this is all said and done. Of course, these things can turn and the technicals can improve. The macro situation concerns me as well, and I'll finish with that here in a minute. And then the ETF that we use technically here to track the NASDAQ 100 index, QQQ, just really screaming higher, hugely overbought. Bearish divergence. You do have a buy signal there, but you have a real bearish divergence in terms of the slope of the MACD and the RSI. Here's where we were at the all-time high, right? We had, moving right up there strongly, although, rolling over. That's what happens with the wedge pattern. Losing it here, overbought, but not as much as we are right here. Okay, so we're in earnings season. You're going to see it jump around. This one's been jumping around all morning. You get good news out of some of these big tech stocks. We continue to go higher. We'll see whether or not these technicals ultimately play out or we burn through them, and then I'll be telling you a much more bullish technical story that the charts just don't allow me to tell you at this point. And then lastly, what I'd like to do is just quickly run through the points I made yesterday on the written blog. So I've had really smart people tell me this makes no sense. The equity market rally in the US in particular just makes no fundamental sense. Well, I get it. Fundamentals say markets should be doing something else the way we interpret them. But here's why I think very simply, and I could come up with more, no doubt. And I could make it more complicated, but let's just say that, number one, that regional bank scare in March actually brought a ton back onto the Fed balance sheet, $400 billion worth, and that was designed to rescue that particular scare, which right now it appears that it did. Number two, a belief that virtually anything artificial intelligence just can't lose, regardless of the overall setup, leading to that weak breadth we just talked about. Three, simply put, it's difficult for a market to roll over when everybody's prepared for it, right? Sentiment was very bearish coming into the year. Number four, a steadfast belief that the Fed will rescue us always. Well, point one kind of supports that theory, right? Number five, the resoundingly bearish sentiment and positioning at the start of the year has pros, professional managers, freaking out and having to buy because they're missing their benchmarks. I mean, you manage money for PERS, the Public Employees Retirement System, and you're competing with another dozen institutional managers, and you're in trouble if, like the global macro hedge fund index, year to date, you're up less than 1% when the market's, rocking and rolling, so to speak. And so you buy, and that, of course, pushes stocks higher, right? Massive option speculation and hedging in a manner that pins stocks to certain ever-rising, to this point, levels. A few months ago, we really spent a lot of time explaining that. Make no mistake, there's been some serious support under this market, and that may explain a lot more than the financial media actually understands. And then seven, a growing consensus that the economy will indeed see inflation reach and hold the Fed's 2% target without crushing the market, i.e. a soft landing. Okay, what's the problem, or what's the counterpoint to those? Well, if the Fed continues to bail everything out the minute something cracks, well, then you're going to exacerbate asset bubbles. And I would say we probably have one in stocks right now. And you're going to keep animal spirits alive, so people aren't going to quell their consumption. And you're not going to get your 2% target, right, for inflation. You'd think that ultimately something's got to give, right? Number two, artificial intelligence. Makes sense, of course, but it's way reminiscent of the late 90s equities dynamic when you look at valuations of a NVIDIA, for example. They leave zero margin for error. Markets don't roll over when everyone's already bearish. Of course, that works in both directions. It's hard for a market to continue to melt higher, despite what we're seeing lately, when everybody's positioned for it. And guess what? Sentiment has pretty much flipped. It's not as extreme as I've seen bullishness, but it's plenty bullish. It's pretty much the opposite of where we came into the year. Fed won't break anything. Ditto number one, right? Bearish pros capitulate. Ditto number three, right? That's just markets don't roll over when everybody's bearish, so they become bullish and they buy stocks and push it up. Well, that essentially gets rid of that underlying potential support for the market. Options, the unwinding of complacency, and we'll call it the volatility space, can become a waterfall in a heartbeat, either under its own weight, and we're in the latter innings, the experts tell us, or in the event of a surprise macro catalyst. There was a 1 week collapse in the stock market in early 2018. They called it Volmageddon, and it was that essentially explained it. Just too much positioning on one side. An ETF focused in that space just completely blew up. You know, the 1987 crash dynamic had to do with positioning and derivatives, that sort of thing. So we're just kind of in a spot here that, that suggests that things line up a certain way and this market can surprise you. The soft landing narrative virtually assures margin compression. And what I mean by that is, weaker margins, thinner margins, or lower corporate earnings. As inflation, which is higher corporate revenue. I mean, nobody likes the inflation except companies that can raise their prices against it or above the inflation rate. As inflation abates in a soft landing scenario, and then as a consequence, therefore, of averting a downturn, the labor market, wages certainly don't go down, or we will have disinflation or deflation in certain corporate inputs, which will help the margins. But I think we can assume that labor remains tight and the commodity markets remain tight. And make no mistake, folks, equities right here are not remotely priced for serious earnings misses like we see in recessions or like we see in this simple soft landing scenario. So regardless of what you're seeing and regardless of what you're seeing in the price action, this is not the kind of market that, at least for us at PWA, that would have us going in and allocating in the way we allocated, from the bottom in 2009 all the way up to late August of 2019. This just is not either technically or fundamentally the setup that allows us to do that. It doesn't mean that these fearful scenarios that I point out are going to come to pass. It just means that the risk that they will is too elevated to sit here and pretend that everything's okay and we're off to the moon from here. Could be the case, but there's too many headwinds that suggest that if you go there, you could get stung hugely, and we want to avoid that if we can. Thank you, folks, as always, for watching and listening. Have a wonderful rest of the week and a wonderful weekend. Take care. Bye-bye.